Hi, I'm Jessamy Walker and I run Brown Dog Financial Planning. This is a short presentation that I gave to some clients last Friday about the coronavirus and the economic cycle that we see ourselves in, and I thought it would be helpful to share with you. So this is now the third recession or market reset that I've been involved in my working career. The first was back in the 90s, and then the technology bubble in 2000, and then the banking crisis 2008. And what we see is that the economic cycle goes around and we tend to see a market reset normally every 7 to 10 years. This one's been a little bit longer coming in that we've had one, the last one was 2008-9, and we're probably 11, 12 years on. But a study of trade cycles in 1937 to try and determine what asset classes worked best in each of the different areas produced a little bit of a pattern. And this is no different. You tend to see a booming economy and everything feels right and we're all confident and business is going well. Housing prices go up, moving is easy, interest rates. We then tend to see inflation come in and interest rates rise to combat that. And that then tends to be the start of the slowdown. And then often there's a trigger. And in this case, it's coronavirus, unfortunately. So each of the investment cycles is slightly different because the trigger that pushes them over the edge is also slightly different. The year 2000, we saw people being scared that the lift wouldn't work when we went past midnight on December the 31st, and all the numbers lined up to 00. In hindsight, that seems really silly now, but at the time it was a very real worry. And the same with the banking crisis. Unless you were affected directly, it was something that went on in the background. And I think this is probably the same. It is something that goes on in the background, but triggered alongside it is this global pandemic. And we're very aware of that because it affects us all directly. So the investment clock and the way it works, and I think possibly at the moment we're sitting between 3 and 6. We're definitely in the slowdown and gloom. We haven't come right around between 5 and 6 just yet, where it really slows down and everybody just feels like the world is about to implode and nothing will ever be the same again. There is still news coming out. There are still things changing day in, day out. It does feel today feels a little bit better. The Fed organised a massive injection of money, but it is still a falling market. We've seen commodities falling, oil, platinum. Money's becoming more difficult for people. We've got a little bit of a stall on real estate, housing prices. No one can move, so it makes it a little bit difficult, but we're kind of stuck around that corner. And as we flow around a recession, we see the slowdown, and then we see a very hesitant recovery, and it comes a little bit stronger and then stronger again, and we go back around the boom. And then in another, 8, 9, 10 years, we may see it again. I personally think that this trigger is a very recent one with the coronavirus, but I think this cycle and the fall-in cycle probably started back as early as 2018. But we saw quite a lot of money and injection into the economy to try and scoop us past, and we sort of scuttled round between 5 and 7 very quickly, and share prices were bolstered. These are the headlines and things from earlier in this year, and then possibly earlier still back to 2018. Neil Dobson and Neil Bailey at the bottom. What has been a difficult year for most asset classes, and will the headwinds continue into 2019? So it really has been triggered by Brexit, triggered by the oil. The Saudis and the Russians have had a little oil war going on in the background. And there have been quite a lot of underlying economic factors that have helped push this along. However, sat underneath it all, or over and above it all, probably all encompassing, has been the impact of coronavirus. We've seen a big shutdown in China. China suspended production, closed their factories, locked down. It's an unusual situation because we haven't had a pandemic of any size that has affected us quite so instantly and so virulently, so immediately, probably since the Spanish flu in 1918. The difference obviously is the massive improvement in medical research, medical circumstances, how to treat this. We do have some history to look back at, and I think we also weren't recovering from a world war with a very a population in very poor health and not really being able to cope. So we're in a much better position to be able to cope. I saw an investment note from the London School of Economics yesterday that Roche, one of the big pharmaceutical companies, has basically diverted their production to testing kits. So where they were making 20,000 in a day, they're now making 900,000 in a month, and they should be able to test 5 million people a month in a relatively short time, which can only be a good thing. We've also seen the impact of the lockdown in China actually that slow the spread of the disease out, and the impact has slowed down massively. They have no new cases being reported in China at the moment. We're obviously a couple of weeks behind Italy, who have had a similar journey to us, and we're probably 8 weeks or so behind China. So hopefully we'll be able to learn from their experiences and be able to do something about slowing this pandemic down. And unfortunately, it's the impact of this pandemic and the unknown way it's going to fold out that is what's playing on the stock market and having such an impact on the FTSE 100 particularly. Balanced portfolios with a mix of asset classes have held up way better, but some of the big equity companies are having to report reduced earnings, lower profits, just a massive change in the way that they're having to work and adapt. But we will adapt and we do evolve, and we're amazing with what we can do like that. So essentially we're designed to adapt and evolve and to survive. You know, we're in evolutionary terms, we're actually incredibly young. And this is a chart that shows the S&P 500, a logarithmic scale of the returns over the last, 1926 onwards. So you can see how small the bear markets are and how big the booms that we have in between. So for those people really worrying about how they're going to survive and will it be okay, and will my business be all right, will my family be all right, you know, the pandemic side I can't do, but the economic side, the average length of a recession is just over a year. We can hang on for a year, we can come out the other side, and we then go around that investment clock I talked about earlier, and we come back out and it starts to recover. I mean, we've had nearly 10 years of a boom since our last. I mean, the banking crisis on this chart looks tiny, but at the time it felt like it went on forever. But our emotions and how we feel, and therefore how we behave, runs alongside this chart. You know, we go through the same emotional boom and bust that the market does. You know, we've started to come off the top and it feels awful. So we all feel terrible. We're emotionally linked to it, and it's really hard to step back and take that emotion out of it and to try and think rationally. I've had a couple of conversations with clients recently that have been purely emotional. Now they know that we've built a plan in and a contingency plan and a what if, and because of their situations, we have these second plan Bs alongside their main ordinary plan. But it's really difficult not to get swept up in what goes on in the real world, or the big wide world even. So this is the emotional response, and this is how we feel. So we're pretty much at the, throw your hands up in horror, it's awful. Right up near the top of that curve, actually. We haven't got as far as crying or spitting the feathers out, getting angry, purple in the face, to actually, it's all over, I can't be doing it anymore, which is where you see what they call capitulation at the bottom. And at that point, it's really easy for people to get sucked into just going, I can't do it anymore, I'm going to sell everything and buy cash and sit in a cave on my own somewhere. But it does go around and it does come around, and we do feel that very hesitant. This is okay. Oh, okay, yeah, this is good. Oh, hey, this is fabulous. Whoa, great, sunshine. Oh, I'm amazing. And then round we go again. In order to be a successful investor, actually one of the best things to be able to do is to buy a mixed portfolio that rebalances and ignore it. Don't even look at the press. Don't even look at the news. Don't get sucked into everything. Just, my money's doing what it should do. Fantastic. Leave it there. Is definitely the best thing you can do. I say it's definitely the best thing you can do, but obviously it does depend on your circumstances and what you need to do. But pretty much, if you can and you can leave it there, don't touch it. It will come back. It will just take a little bit of time. And I don't have a crystal ball, so I don't know how long that'll take, but it will come back. At this point, as I say, it will come back. The compliance officer is turning over in the corner going, say possibly, say should, say maybe. And I can only say possibly should, maybe, because I don't know. but I can only base my decisions on what's historically been the case. And I've been down this emoji roller coaster. I've done that. I've puked at the bottom and I've got it all wrong. But to have come out the other side, and I've learned. And one of the biggest things I have learned is that we make really, really bad financial decisions when they're emotionally driven. So I had a conversation with somebody this morning who wants to take all the tax-free cash out of her pension because her work's dried up. She's an events planner, so all those kind of public things have died up. And it's really, really tough. But we had a sensible conversation and I said, do you know what? Do you remember all that money you've got in cash? That's for times like this. She said, but that's my emergency money. And I went, well, if this isn't an emergency, I don't really know what is. And so again, there's a plan, there's a basis to it. And I can't stress the importance of having a plan and the plan B, and then plan C and plan D if plan A doesn't work in the first place. But have a plan, and it really will. Again, compliance says it possibly will, but I personally believe that it will. So this goes back actually to my point about different asset classes balancing out better and not having all your eggs in one basket. These are 3 or 4 of the funds that I happen to use fairly regularly. It depends who you are and how risky you are. But if you're close to retirement and or need the money in the next couple of years, do you know what? You're in either D or B. You're not touching the hard stuff down at A. If you're only 40 something, you're probably buying something a little bit more racy that's based around the FTSE and pure equities or a mixed tracker or something like that. But again, it depends on who you are, how much you need to rely on the money, and actually what happens if you can't afford to lose it, because that you may have a massive tolerance for risk and may have a great ability for it, but actually if you don't have the capacity to run out of money because you don't have a buffer and a backstop, then that changes what you should be investing in. So my biggest takeaway for all of you from this is don't panic, have a plan B, actually don't look at the news. I have another financial advisor friend who calls it the negative events weekly service, because all they do is tell you all the bad stuff. There isn't the Roche are throwing loads of money at developing testing kits, or actually they're doing some testing on rheumatoid arthritis drugs that may be able to work, or that vaccination development's gone on, or actually that, do you know what, the global companies of the world are 30% off, and that's probably quite a nice place to be if you're looking at going in. But it is really a don't panic, don't look at it, don't trust in the portfolio you've built, and trust that actually if I think it's going to go worse than that and you're a client of mine, I will be phoning you. But actually I think this is a great opportunity for end of tax year planning, new tax year planning. It sounds really mercenary when it's at a situation like this, but actually it's not a bad thing to do, just to have a bit of a plan. So hopefully this has shed a little bit of light on why the economy behaves like it does, and that actually it's not really a bad thing. It is a reset. We all need a reset. I don't know about you, but 12 weeks locked at home and or being able to go out for a walk with my dog every day would be lovely. I'm actually in the office, doing what I need to do, but yeah, taking my dog for a walk in the sunshine like this, fantastic. So if anybody would like to talk more, and I do mean anybody, I don't mean that just to be clients, then I'm quite happy to have a conversation in obviously relatively generic terms about how things could affect you and what you can and can't do about it. Do give me a call. There's absolutely no charge for a first chat about how things work and what they can do. And if I can help you, then I will. That's my contact details are on the slide. Give me a call or drop me an email. It's Jess Walker at Brown Dog Financial.